For the month of December, I've made a gross profit of around $130,000. And for the past few months, specifically only trading the S&P 500, I've had some of my most profitable months and the most consistent months. Now, despite all this, there's still a lot of things that I need to improve on, and there's still a lot of mistakes that I do on a daily basis that I'm gonna go over in this video that I need to improve with. And anybody watching this can learn something from my mistakes and even some of my successes. I'm gonna go over some of my trades, winners and losers, bar by bar in a live replay format so you could all see what I saw at that exact moment and things that I did right and things that I did wrong. So I've ended the month of December with a $130,000 gross profit with a 41% win rate and about a 7.5 to 1 average win to loss ratio. Now, I really want to first talk about December 27th because I took 3 trades. 2 of them were unsuccessful, and 1 of them was a massive winning trade. This is important because the 1 winning trade was an A+, 10 out of 10 perfect setup that I'm gonna explain what I saw, how I saw it, and what made me click the buy and sell button. But the 2 trades to follow this were kind of stupid trades that I should have avoided, that I've noticed common similarities in my data that I've been doing wrong, and I want to use this to improve for myself, but everybody watching this to also understand my mistakes. That way you don't make the same ones. So the first thing we have to talk about with this trade is the overall trend of the market. On the S&P 500, we can see a clear downtrend here where the market is putting in lower lows and lower highs. The reason why I'm making this a fact is because the mistakes that I've been making this month have been going against the trend, and the best trades have been going with the trend. So the trend before the market was open was clearly downtrending, and closer to the opening bell, we could see some selling pressure coming in, and as the market opens, in the first 10 minutes or so, we begin to sell off and move down. Now, on this move down, strictly looking at a candlestick chart, there's not much significant here other than the market moving down, signifying how strong or how weak the selling volume is. Now, this is why I always emphasize reading the tape and understand what is going on behind the candlesticks with the buying and selling volume. So I'm going to replay this bar by bar here, and I want you all to notice at 60.50, we're going to see what I call a negative delta building into the market. As the market is selling off, we can see on the depth of market here, 60.50, we see a negative delta of minus 853. And if we were to zoom into the heat map, we could see larger prints coming through here for strong, aggressive selling that is stepping in. Now, a few minutes later, the market's going to sell off, and that negative delta that we saw was minus 800 is now minus 3,900 at price 60.50. Zooming in on the heat map, you can see the large red prints, the large red bubbles there, indicating a lot of trades are hitting the bid very strong and very aggressively with these large block sell orders. Fast forwarding even more, the market sells off, and now at 60.50, we see a negative delta of minus 5,100 on the depth of market here, where there's 5,700 contracts hit the bid aggressively, and only 600 hit the offer aggressively, giving us a negative delta of minus 5,100. If that term is a little confusing to you, I would recommend checking out the order flow series. I'll link that in the description of this video. I recently did it on my channel. But just looking at the heat map, we could see at 60.50 on multiple occasions, large red bubbles or large aggressive block sell orders coming into the market as we're moving down. Now, this is around 9:36. I'm going to speed up this replay even more, and I want to get to around 9:40 a.m. Eastern time, which is right here. The market is aggressively selling off, and what this looks like on a candlestick chart is simply this right here. Again, looking at this chart alone, we would not really be able to pinpoint if there's a large seller present in the market or how strong or weak the volume is. But at 60.50, the level that I just marked, we could see some significant order flow activity that it's our job to keep a very close eye on. When I see these type of block buys, block sells, I'm carefully observing the auction and seeing if this level rejects, seeing this level supports price, and what does the auction do if it retests it. On this day, on the 27th, what I was observing was to short the rallies because, again, following the trends, the market is downtrending, shorting the rallies into this 60-50, 60-54 level. As long as it remains under, I'm looking to short these pops. This was my game plan as the market is developing, and this is kind of what I do in intraday commentary. I just update my thoughts in real time as the market's developing. Now, a few minutes later, at 9:49, when the market rallies up like this, it sparks my interest in taking the market short. The reason for this is, number one, we're in a clear downtrend. Number two, the market is breaking above this downtrend and we are trying to break out with strong, aggressive buying volume. Now, I want to show you all what the tape looks like at 9:47 if we were to speed this up bar by bar in real time. What we're going to see here is this downtrend line, which we could also see on the heat map, be broken above with strong, aggressive buying volume. You're going to note this by large green bubbles coming in, which is large trades hitting the offer. You can see all the green strong buying up here. Now, with this, the market is still technically rejecting this strong seller here at 60-50, the negative delta, that possible. We don't know if it's validated as a strong seller, but if the market rejects this range, then we can validate a strong seller is present in the market. Now, another thing that I want to talk about is the market's not always going to reject the level or the block buy or block sell exactly to the T. Sometimes it occurs where we'll hit 60-50 perfectly and reject, and that's a perfect world. But you have to give it a little buffer room. I like giving it 4 to 6 points on the E-minis. 4 to 6 points gives me enough buffer room that says, hey, this level's being tested, or hey, this level's being accepted. And this gives me the buffer that gives me solid validation. The market may not reject it perfectly, but if we come into this range and there's selling activity here, this could be a good opportunity for me to reverse the market. So in this case, at 60-50, which I'm now going to mark with a horizontal line, the market is testing this level, and while we are testing it, we are seeing a flux of strong, aggressive buying volume come into the market. If somebody is buying, somebody else has to be selling. Could it be that same seller that we saw earlier in the session at 60-50? Absolutely. When the market is consolidating like this with all this aggressive buy volume, but the market's not moving up, I personally view this as possibly that seller there who now is passively entering the market and has an agenda to bring the market down, especially with such an important retail trap of, hey, this downtrend line just broke. The volume is now increasing. You can see the volume by time down here is increasing. So a lot of retail traders will be buying this breakout. And when I know a lot of traders are buying something, I am first looking to reverse and sell the move. So with this analysis, and this is done in real time, I basically shorted this pop up into this level of resistance at 60.52 with a 2-point stop loss going for a low of day target. It was about a 12-point target for a 2-point risk, about a 6-to-1 risk to reward ratio. Well, directly after I entered this trade short, which I'm now going to highlight by this yellow oval, the market began to sell off, broke under low a day very strong and very aggressively, and on the first green candle is my cue to get out of this trade because of how fast it blew past my target. And this was a quick 10-minute trade, and I grossed a $35,000 profit off of about $4,000 worth of risk, trading 35 E-mini contracts. If you've all been following me for a while, you all know that I usually take one good setup in the first couple of minutes, and once I hit that trade, I walk away, I shut down my computer, and I go enjoy the rest of my day not behind the markets. But for some odd reason, I think this is like the mistake that I want to get into, due to how well I've been trading and how, I don't want to say cocky, but how easier it's been to read the market conditions, I'm getting sort of ahead of myself and making good profits and trying to make even more and more and more because of how well I've been trading. And this brings me into another thing of how the market's in a clear downtrend. And a lot of my losses this month by reviewing my data has been simply going against the trend, looking to reverse the move based on what I'm expecting the market to do, because if it does what I want it to do, I'm going to make more profits. So it's both a psychological little barrier that is bleeding into a technical barrier. I'm doing something because I want to make more money, and I'm going against what I normally do because I want more money in my account because of how well I've been trading and my recent trading performance. So what I did this day was, the market's in a clear downtrend. That rally that I sold the market into, that I shorted, was a perfect opportunity for sellers to reload. Now what I did was, is on any sign of buying or any side of life, for example, down here, I longed the market. Another example down here, I longed the market again. And yes, gratefully, the one winner was massive, and the second trade was a loser, was a $3,500 loss. And then the third trade, which was another loser, was a $4,000 loss. Gratefully, my winner outweighs the two losers, but it's just frustrating kind of going against my rules because I'm trying to catch a bottom or go against the trend to simply just make more profits. So something that I've noticed just by reviewing my data and my trades and even in my head is my own ego. Like after a couple big winning trades or big winning days or big winning months and extracting profits out of the market, my ego or my thoughts start doing some of the trading for me. The way I look at it is like once you have a cushion in the market or once you made a lot of profits, in a day, in a week, in a month, you kind of go and approach the market a little differently, which is good and is bad. It's bad in the sense of once you have a cushion, you tend to, at least me personally, start doing things that you normally would not do or start putting risk on for trades that you would normally not enter. This is due to having a cushion. This is due to having more profits in your pocket that you can risk if you want to make more profits. Now, this relates back to the ego because once you have a really large winning day or a large winning month or large winning week, you start feeling a little euphoric. You start feeling on top of the world that this is going to continue forever. And the market could easily humble me, could easily humble you all watching this video. But it's so important to stay level-headed to that. Don't let one winning trade or one winning day get in your head, or don't let 1 or 2 or 3 profitable months get in your head and say it's going to continue. This momentum is going to go forever and ever, and I'm going to get better and better. I'm going to make more profits every single month, every single year that I'm trading. And while that's possible, we have to think realistically, and the market is a mechanism that every single day will be different. It's so important to follow our trading setups, what we know works out for us the best, and to not follow what we think will occur next based off of us wanting to make more profits or based off of our thoughts doing the trading of where we think the market's going to head next based off of us trying to predict the future. The point I'm trying to get here is if you have success, you make profits today, you make profits last week, don't let that past profits affect what's happening right now in the present moment. What happened in the past has happened, good or bad. What we have to focus on is right now. We can't let our ego, good or bad in the past, affect what's going on in the present moment right now, whatever the market's providing us. And this also will help us lead to kind of like blindsided by the market. What we think will happen will now enable us to ignore the facts that the market's providing. Let's just say we think the market's going to bounce off of a level of support or demand. We think that's going to happen because our ego is going to place us in positions that we want to take trades seeing the market move up. But let's just say the market's in a downtrend and we have no business longing the market off that support level. Well, if we stay level-headed and don't let the past or don't let our ego affect us, we will be in the present moment thinking and we would not go against the downtrend or we would not long that support level just because we think it's going to bounce there. We would stay level-headed. We would remain objective. Remaining objective is key. And we would do what the market's telling us. And that will either make us avoid a trade that we should not be taking, or that'll help us take a really high quality setup, remaining objective of whatever the market's providing. And this is going to bring me into December 23rd's trading day because I took 3 trades and all 3 of them were losses. And it was my biggest losing day so far in the month of December. What we're going to notice here is every single trade was a short position, meaning I was betting on the market going down. We could see a $5,000 loss. Another $5,000 loss. And then the third trade was a $3,000 loss. Each trade was shorting as the market was uptrending. So here we could see the market selling off into this level of demand. And I kept shorting all the pops. And some of them were successful but failed to hit my target. And I was shorting into the strength, shorting as the market now is forming an uptrend. We could see earlier in the session we are downtrending, lower lows, lower highs. Now the market forms a low at this level of demand, and now the structure is switching because now we are putting in higher lows and higher highs. So shorting this move, especially after it bouncing off of a level of demand, was simply based on where I wanted the market to go or where it made sense for it to head next. The market's not going to care about my feelings. The market doesn't care if I say it's going to go up or down. I just have to trade my setups. And these 3 trades were not based off my setups. Instead, they were based off of where I thought the market was going to head, and I paid for that on this day. So now the third trade I want to go over is Friday, December 20th. It was a one and done type of day. And again, like, this is one and done. Make excellent profit, walk away. Don't try to force other setups. This was 35 E-mini contracts. The risk was of 3 points on 35 contracts. So it was close to $5,000 worth of risk. And really what I saw here was an uptrend in the market. So going to a candlestick chart, we could see here in the overnight session, we were downtrending. And similarly to the previous trade that I just went over, now the market is trying to bounce. We're putting in now higher lows and higher highs. So now it once was a downtrend, we are now uptrending. So looking at the most recent trend on a 1-minute chart, we could see the uptrend. And as the market is opening up, we are bouncing off this significant level of interest. And on this, we see aggressive selling volume come in. The one thing that I want to say here, so I got long at 937 when the market looks just like this. We're consolidating, we're moving sideways, we're kind of flagging, the market's pulling back. Now on this consolidation here, when I got long at 59.07, when the market pulls back here, it was an 18 to 23 point target for 3 points worth of risk. So, I mean, it was about a 7 to 10 to 1 R multiple, longing the pullback. And the reason why I get long here, I want to play this replay here so you could all see what I saw, is if the market is uptrending. This is a very good rule of thumb and something that I use very frequently. On strong uptrending markets, if the market pulls back or if the market consolidates, and on this pullback or on this period of consolidation, the market holds, but it holds with aggressive selling pressure. So let's speed this up. Here's the rally up, and I want to slow this down right here. So we could see the market is consolidating, it's pulling back, and it's uptrending after it bounces off this level of demand. When I see a pullback hold on aggressive selling or consolidation occur on aggressive selling on an uptrend, this to me is a bullish signal, and this is why I longed this dip, and this is how, or what the market did after. We could see this area that I'm gonna highlight right now as an area where the market pulled back, consolidated, and it was done with red prints. And to make it simple, it's the red prints just mean aggressive selling. So as the market's consolidating and holding, the aggressive selling is coming into the market, but the market's really not selling off. In fact, it's still uptrending. We're still putting in higher highs, and we're still putting in higher lows. So we're still uptrending despite this selling. This, I view it as a passive buyer, similar to the first trade that I went over as a passive seller. This is just now flipped. And then the market rallies and we come up into 59.30, which was my target. And this was a trade that lasted 3 minutes, 2 minutes time to make this profit. You know, you see 2 minutes worth of trade time, but you don't realize that I've been trading for 9 years. And through many successful trades and through many unsuccessful trades, this is the result. So I don't want you all looking at the profits. Just understand it's a process. Understand how much I am risking for how much I am going to be rewarded. And understand it's all about perspective. 1 contract, 5 contracts, 35 contracts. It's all relative. Look at the risk to reward because that is the most important. So I think I'm going to end the month there. We still have December 31st, which is going to be the day you're watching this video. But it's a half day. I'm not very interested in trading around it. Maybe I do, but there's a lot of things that need to be cleaned up, especially if you've seen my November recap. Just some simple mistakes that go a long way in terms of preserving losses and maximizing my gains. So despite not trading for more than half of the month, I was on vacation from the 4th to 13th. Obviously Christmas, and now we have New Year's. I'm looking forward to keep this momentum going in 2025. I'm looking forward to the new year. I know what I have to do. It's now just doing it, and I'm sure a lot of you can relate to that. You all know what you have to do. It's just consistently repeating it and doing it over and over and over and avoiding what you know you should be avoiding that is causing mishaps and causing losses in your trading. So I'm going to end the video there. If you learned anything, I would just appreciate a comment. If you're new to my channel, subscribe, and also drop a like on this video. But I'm ending it. Peace out.